It's 4:47 a.m. on a Tuesday. A portfolio manager in Singapore is staring at her Bloomberg terminal, refreshing earnings previews that won't be released for another 12 hours. In a few hours, 5 of the most valuable companies on Earth will tell us exactly how much they've gambled on artificial intelligence. The number? $650 billion in a single year. That's more than the entire GDP of Sweden, more than the entire GDP of Poland, and this week, we find out if it was worth it. Here's what nobody's talking about. The Magnificent Seven minus NVIDIA are now growing earnings slower than the other 493 companies in the S&P 500. 6.4% growth versus 10.1%. The supposed titans of American capitalism, trailing the pack. So what's going on? Today we're breaking down what these earnings reports actually mean and what it signals for anyone holding these stocks in their portfolio. Let's set the scene. The 4 major hyperscalers, Amazon, Google, Meta, and Microsoft, are planning to spend somewhere between $635 and $665 billion on capital expenditure in 2026. That's a 67 to 74% increase from $381 billion in 2025. We're talking about the largest infrastructure build-out in corporate history. Amazon leads the pack with $200 billion in planned capital expenditure for 2026. That makes them the single largest spender among hyperscalers. Alphabet, Google's parent company, announced CapEx guidance of $175 to $185 billion. That's nearly double their $91 billion in 2025. Meta's projected $115 to $135 billion in 2026 CapEx represents their most aggressive infrastructure build-out in company history. And here's where it gets interesting. All of this spending comes at a cost, literally. Free cash flow across these 4 companies dropped from $237 billion in 2024 to $200 billion in 2024 to $200 billion in 2025. That's $37 billion less cash flowing through these companies, and the spending is only accelerating. 5 CEOs will stand in front of analysts this week and explain why spending more on AI infrastructure in a single year than entire countries produce is a rational business decision. The question isn't whether AI will transform industries. Most analysts agree it will. The question is timing. When do these investments start generating returns? According to one financial analysis, quote, "The industry is investing in infrastructure at a pace that far exceeds the current revenue-generating capacity of AI products and services." This is the core tension. Build the infrastructure now, hope the applications follow, or risk being left behind when the AI revolution actually arrives. Here's a number that should make you think. Without NVIDIA, the Magnificent Seven are projected to grow earnings just 6.4% this quarter. Meanwhile, the S&P's other 493 companies? 10.1%. Let that sink in. The companies that dominated market returns for the past 2 years are now underperforming the companies they were supposed to leave in the dust. But here's the counterpoint. Magnificent Seven net income is estimated to grow 25% in 2026 compared to just 11% for the other S&P companies overall. So which is it? Are they struggling or dominating? The answer, frustratingly, is both, depending on how you measure and when you measure. This week's earnings will tell us which narrative is winning. The bulls say AI infrastructure investment is essential for long-term dominance. The bears say it's .com excess all over again. On April 30th, that's today, Alphabet, Amazon, Meta, and Microsoft all report earnings. Apple follows tomorrow, May 1st. Alphabet specifically is expected to report earnings of $2.64 per share, representing a 6.1% year-over-year decline. A decline from Google. That's not something investors have seen often, and it raises the question everyone's been avoiding. When does spending translate to earning? The bulls have an answer. They point to historical precedent. Railroads, electricity, the internet, transformative infrastructure always requires massive upfront investment before returns materialize. Amazon built warehouses for years before e-commerce dominated retail. Google invested in data centers for a decade before cloud computing existed as a business. The bears counter with .com-era comparisons. Pets.com, Webvan, companies that raised billions on promises of future transformation and delivered nothing but bankruptcy. As of April 28th, 28% of S&P 500 companies had already reported Q1 earnings. The trend so far? Companies that emphasized AI costs over AI revenue have underperformed. Now, here's what the smart money is actually watching. Not headline earnings, not revenue growth. 3 specific metrics that separate AI hype from AI reality. First, you might want to consider looking at free cash flow trends. Not just the number itself, but the direction. Is cash flow stabilizing despite increased spending or accelerating downward? Second, AI-specific revenue growth rates. Are these companies actually generating income from AI products or just talking about future potential? Third, guidance language. When CEOs talk about AI monetization timelines, are they speaking in quarters or years? The difference tells you everything about their confidence. Let me give you a framework that historical patterns suggest, though past performance never predicts future results, for thinking about these investments. When railroads were being built in the 1850s, investors who held through the initial cash burn earned 12% annual returns over the next 50 years. Those who sold during the construction phase, they missed everything. But, and this is the honest version, most railroad companies also went bankrupt. The infrastructure survived. The original investors often didn't. That's the parallel that keeps analysts up at night. AI infrastructure will almost certainly create enormous value. The question is, which companies capture it? One beneficiary that sidesteps this risk entirely, NVIDIA. They get paid on every dollar of AI infrastructure spending without bearing the capex burden themselves. It's like selling picks during a gold rush. You make money whether the miners find gold or not. But NVIDIA's valuation already reflects this advantage, which brings its own risks. So what might make sense for your portfolio? One approach many advisors suggest: trim positions if any single stock represents more than 20% of your holdings. Concentration risk cuts both ways. Yes, you might miss upside, but you also limit damage if these bets don't pan out. It's risk management 101. Here's a practical approach you might consider. Don't chase the AI trade blindly. The other 493s and P companies are currently growing earnings faster. That's worth paying attention to. If this kind of analysis is useful to you, consider subscribing. We break down stories like this every week, translating Wall Street complexity into decisions you can actually make. According to RBC Wealth Management, the path from AI investment to scalable returns typically follows a 3-phase pattern: build, optimize, monetize. Most companies are still firmly in Phase 1. Phase 2, optimization, is where companies learn which AI investments generate returns and which are just expensive infrastructure with no monetization path. Phase 3, monetization, is where it all comes together, or doesn't. And nobody knows how long Phase 1 will last. 6 months? 2 years? 5? I want to be clear about something. Your situation is specific to you. Your risk tolerance, your timeline, your tax bracket all change the math here. But what historical patterns tend to suggest, and you should verify this with your own advisor, is that concentration risk during uncertain periods has historically destroyed more portfolios than it's built. The smart play might not be picking winners. It might be ensuring you survive long enough to benefit regardless of which companies capture AI's value. Now, let's talk about what could go wrong this week, because the downside scenarios matter as much as the upside. Scenario 1. Guidance disappointment. If any of these companies suggests AI monetization is further out than expected, the stock could drop 10 to 15% in after-hours trading. Scenario 2. Capex acceleration. If companies announce even higher spending without corresponding revenue, free cash flow concerns could trigger institutional selling. Scenario 3. The positive surprise. Clear evidence of AI revenue growth exceeding expectations could send these stocks to new highs. It's possible. Markets surprise. The honest truth? Nobody, not the Fed, not Wall Street, not your favorite finance podcast, knows which scenario plays out. What we can do is prepare for all of them. Here's what you might want to consider before markets open tomorrow. Have a plan for both directions. Know your exit points before emotions take over. One approach that research suggests: write down your decision framework now. If stock X drops Y%, I will do Z. Remove emotion from the equation before it arrives. And remember, a pattern is not a prediction. Historical data suggests outcomes 70% of the time. That means 30% of the time, it doesn't play out that way. Your job isn't to bet on the pattern, it's to prepare for both outcomes. That's what separates investors who build wealth from investors who destroy it. Let me leave you with one final number. The combined market cap of the Magnificent Seven, $14.3 trillion. That's roughly half the entire U.S. stock market. When companies this large make bets this big, it affects everyone with a retirement account, a 401k, a pension, index fund exposure. You're in this whether you chose to be or not. That's why understanding what's happening matters, not to panic, not to make emotional decisions, but to make informed ones based on actual data, not headlines. $650 billion. 5 earnings reports. One question: is this the infrastructure for the next computing revolution or the most expensive corporate gamble in history? We'll be watching the numbers closely and breaking down what they mean as earnings come in. Because in a world where AI spending is reshaping corporate America, staying informed isn't optional. This is Money Moves Daily. Until next time, stay sharp, stay skeptical, and make decisions based on data, not hype. And remember, this is not financial advice. Always consult with a qualified financial advisor before making investment decisions. Talk soon.